Hello there, students of economics. Welcome back to this teaching lesson or module titled National Income and Related Aggregates. We're moving on to yet another topic in macroeconomics. Studying about national income accounting will help us to understand how national income accountants get a sense of the economic health of the country. So stay with me and let's learn something new. Yeah? In this lesson, we will learn about some basic concepts in national income accounting, and we will learn about the circular flow of national income, the two-sector model. Let us begin. The first concept we're going to deal with is, of course, national income. What is national income? It is the money value of final goods and services produced in an economy during the period of an accounting year. So while we are calculating national income, what we are essentially trying to do is learn what is the worth or value of all that is produced in our economy. Especially we are considering the value of final goods, which means we are not taking into account intermediate goods that are used in the process of production to produce the final good or final product. Secondly, the time frame of calculating national income is an accounting year, which of course begins on the 1st of April of any given year and ends on the 31st March of the next year. National income is also defined as the sum total of value added by all the producing units in the economy during the period of 1 year. In the videos that follow, we will be learning about the methods of calculating national income, one of which is called the value added method. It is then that you will understand this definition very well. For now, let me tell you that value added is the difference between value of final goods minus the value of intermediate goods used in the process of production. So at every level of production, the value added is calculated and is added to give us the national income. The next concept we're going to define is GDP or gross domestic product. What is gross domestic product? It is the money value of final goods and services produced in the domestic territory of a country during a period of one accounting year. When we define national income, we saw that we spoke about it in terms of money value, final goods and services produced in an economy during a period of one accounting year. While here, while defining GDP, we are considering the value of goods and services produced in the domestic territory. I want to throw a little light on what we mean by domestic territory. In common language, the domestic territory of a nation is understood to be the territory lying within the political boundaries of a country. That considered, you have shipping and aircrafts operated by residents of the country across different parts of the world. For example, Indian ships moving between perhaps Japan and Korea regularly, or airplanes operated by Air India between England, Canada, Australia, could also be a part of the domestic territory of our country. So also fishing vessels, oil and natural gas rigs and floating platforms operated by our residents, the residents of our country in international waters, is also a part of our domestic territory. And now moving on to the next concept, which is private income. What is private income? It is the total factor income from all sources and current transfers from the government and the rest of the world accruing to the private sector. So from the definition, we understand that private income would essentially mean all the incomes that are relating to the private sector, which means that private income is the sum total of four values. First being factor incomes to the private sector. When we're talking about factor incomes, we essentially mean rent, interest, wages, salaries, and profits. That is the income to land, labor, capital, and enterprise. The next entity that is included in private income is net factor income from abroad. Now this is the difference between the factor incomes earned by Indians abroad and factor incomes earned by foreigners in India. Then we have current transfers or transfer payments coming from the side of the government. So also current transfers from the rest of the world that are received by the private sector. Now when we talk about private sector, we just don't mean private individuals, but it also could mean private corporations or business enterprises. So the sum total of all these factor incomes to private sector, net factor income from abroad, current transfers from government, and current transfers from the rest of the world going to the private sector would give us the figure of private income. And here we have another concept called personal income. Let us seek to define it. What is personal income? It is the income actually received by the individuals and households from all sources in the form of factor incomes as well as current transfers. So we have a formula here for personal income, which is personal income is equal to private income, which we just saw in the previous slide, minus undistributed profits and minus corporation tax. Since we are talking about personal income being the income of individuals and households, we deduct the income to corporations and business enterprises, which is undistributed profits and corporation tax. These are concerned with business enterprises or entrepreneurs, and so we have to deduct these values from private income to give us personal income. And the next concept is PDI, which stands for personal disposable income. What is personal disposable income? It is the income remaining with all the individuals and households after payment of all taxes levied against their income and their property by the government. So personal income is what is left behind after individuals and households pay all their taxes, perhaps on their income or their property, to the government. Whatever is left behind is called as personal disposable income. So it points to the purchasing power of individuals and households. Let us now set out to study a very important concept, which is the circular flow of national income. It is obvious that goods and services are going from one sector to another, and so we need to study all the areas where goods and services are produced so that we can calculate the national income. Before we venture out to study about national income accounting methods, we need to understand the concept of circular flow first. Circular flow of national income involves different sectors of the economy. That is the producing sector, the household sector, the government sector, and the rest of the world. Let us consider a very simple economy based on the following assumptions. The first assumption, we assume that the domestic economy comprises of only two sectors, producers and households. Second assumption, the households spend their entire income so that there are no savings. The third assumption, domestic economy is a closed economy so that there are no exports and imports. And the fourth assumption, there is no government intervention in the economy. In order to understand how national income is accounted for, we need to study how the goods and services and value of the goods and services changes hands in the economy from one sector to another. In our syllabus, we will be considering only the two-sector model. So here we go. In this two-sector model, we have two sectors, that is two entities, one being the households and the other being the producers. It all begins with the households. It is the households that provides their factor services to the producers who produce goods and services using these factor services and raw materials and producer goods. So the producers sell the goods to the households again. So there is a flow of factor services from households to producers. You can note the direction of the arrow. And there is a flow of goods and services from the producers to the households. There is another flow taking place simultaneously. The households will not give their factor services to the producers for free, will they? They will be receiving what is called as factor payments. And these payments are made by the producers to the households. When the households receive these payments, we call them factor incomes. It is one and the same. For the goods and services received from the producers, the households pay them consumption expenditure. Now, listen carefully. The flow of factor services from households to the producers and the flow of goods and services from producers to the households is called the real flow. Whereas the flow of factor payments from the producers to the households and the flow of consumption expenditure from the households to the producers, shown by the blue arrows, is called the money flow. So these two flows happen simultaneously. These exchanges happen simultaneously. And this is how national income flows between sectors. For simplicity's sake, we have taken just a two-sector model as you see here in the slide. And now let us set out to explain the diagram of the two-sector model. As we saw, there are two flows, that is in real terms and in terms of money. The real flow is the flow of goods and services across different sectors of the economy. So we saw in the slide, there is a flow of factor services from households to the producers, and there is a flow of goods and services from producers to households. Well, money flow, on the other hand, is the opposite of real flow. While factor services flow from households to producers, factor payments flow from producers to households. So here we see that there is an exchange in terms of money. So that comes under the money flow. Next, the total production of goods and services is equal to the consumption of goods and services by the household sectors. So we can see clearly in the diagram that whatever is produced in the economy is consumed by the households. Thirdly, factor payments by firms is equal to factor incomes earned by household sectors. So I told you earlier, when the households receive the payments, we call it factor incomes, and when the producers make the payments to the households, we call them factor payments. So both are one and the same. The consumption expenditure of the households is equal to the income of the household sector. So we saw in the two-sector model that whatever they earn in exchange for the factor services, they spend it in the form of consumption expenditure when they purchase the goods and services. Let me give you a little piece of information here. The work of computing the GDP is done by the Central Statistical Organization, that is the CSO, which works under the Ministry of Statistical and Program Implementation in India. Here I've put a little illustration to help you to understand what GDP is all about. It is the value of final goods and services produced in a period of one accounting year. And when we measure GDP, it helps us to make comparisons and it helps us to understand economic performance of our country. That brings us to the end of this teaching module, wherein we learned some basic concepts in national income accounting like national income, GDP or gross domestic product, private income, personal income, and personal disposable income. And later we learned about the circular flow of national income in a two-sector model. Thank you, econ students, for giving me a listening ear. I would urge you and encourage you to study the basic concepts thoroughly and understand for yourself the circular flow of national income thoroughly, because that is a very important concept from the examination point of view as well. Learn, study, and grow, children. All the best and stay safe and stay blessed.